Cash is the lifeline of every business. A company can have growing sales, loyal customers, and strong profits on paper, but if cash continues to decline, the business can quickly face serious challenges. In this video, you will learn how to manage declining cash balance in business finance. The first step in managing declining cash balances is identifying the real cause behind the problem. Many owners assume lower sales are the only reason cash decreases, but that is not always true. Sometimes businesses are growing rapidly, yet cash balances continue to fall. This can happen when customers pay slowly, inventory levels become too large, expenses rise unexpectedly, or owners spend money without monitoring financial reports. Understanding exactly where cash is going helps owners create practical solutions instead of making emotional decisions. Reviewing bank statements, cash flow reports, and monthly financial statements provides valuable insight into spending patterns and cash movement. One of the most effective strategies for improving cash balances is strengthening accounts receivable management. Many businesses wait too long to collect payments from customers. If customers take 60 or 90 days to pay invoices, the business must continue paying expenses while waiting for money to arrive. This creates pressure on cash reserves. Owners should send invoices immediately after completing work, establish clear payment terms, and follow up consistently on overdue accounts. Offering small discounts for early payments may encourage customers to pay faster. Automated reminders and regular communication can also improve collection efficiency. Faster collections often create immediate improvements in cash availability. Controlling expenses is another important step in protecting cash balances. During periods of declining cash, business owners should review every expense carefully. This does not mean cutting essential investments that support long-term growth, but it does mean identifying unnecessary spending. Subscription services, unused software, excessive inventory purchases, entertainment costs, and inefficient processes can quietly drain cash over time. Creating a list of fixed expenses and variable expenses helps owners understand where adjustments can be made. Negotiating better terms with suppliers or reducing non-essential spending can preserve cash without affecting operations significantly. Inventory management also plays a major role in cash preservation. Many companies hold more inventory than necessary because they fear stock shortages. While inventory is important for serving customers, excessive inventory ties up valuable cash. Money invested in products sitting on shelves cannot be used to pay bills, hire employees, or invest in growth opportunities. Businesses should regularly analyze inventory turnover and identify slow-moving products. Reducing excess inventory, improving purchasing decisions, and forecasting demand more accurately can release cash back into the business. Efficient inventory management often improves both profitability and liquidity. Business owners should also create short-term cash forecasts when cash balances begin declining. A cash forecast estimates expected cash inflows and outflows over the coming weeks or months. Even a simple forecast can provide powerful insights. Owners can see upcoming obligations, identify potential shortages, and prepare solutions before problems become severe. Forecasting allows businesses to make proactive decisions rather than reacting during emergencies. It helps answer important questions such as whether additional financing is needed, whether expenses should be delayed, or whether sales efforts should increase. Businesses that forecast cash regularly are usually better prepared for uncertainty. Increasing sales remains one of the most effective ways to strengthen cash flow, but it should be approached strategically. Many businesses respond to declining cash by lowering prices dramatically in an attempt to attract customers quickly. While discounts may increase sales temporarily, they can reduce profit margins and create long-term challenges. Instead, companies should focus on selling higher margin products, increasing repeat purchases, and improving customer retention. Existing customers are often easier and less expensive to serve compared to acquiring entirely new customers. Building stronger customer relationships can support both revenue growth and improved cash generation. Payment timing is another factor that affects cash balances significantly. Businesses should aim to collect cash quickly while managing outgoing payments efficiently. Negotiating longer payment terms with suppliers may provide additional flexibility during difficult periods. If customers pay within 30 days but suppliers allow payments within 45 or 60 days, the business gains additional time to strengthen its cash position. However, companies should maintain healthy supplier relationships and avoid damaging trust through late payments. Open communication with vendors can often lead to temporary accommodations during challenging periods. Business owners should avoid making large purchases when cash balances are declining unless those purchases are absolutely necessary. Equipment upgrades, office renovations, or expansion projects may need to be postponed until financial stability improves. Preserving liquidity should become a priority during uncertain periods. Owners should ask whether each purchase directly supports revenue generation or operational efficiency. If the answer is unclear, delaying the expense may be the wiser choice. Protecting cash today creates greater flexibility for future opportunities. Another valuable strategy involves building emergency cash reserves. Many businesses operate without any financial cushion, making them vulnerable to unexpected events. Economic downturns, customer payment delays, supply chain disruptions, or seasonal fluctuations can quickly create financial stress. Establishing a reserve fund helps businesses navigate difficult periods with confidence. Even setting aside a small percentage of monthly profits can gradually build meaningful reserves over time. Businesses with emergency cash are often able to make better decisions because they are not forced to react under pressure. Financing options can also provide temporary support when cash balances decline significantly. Business lines of credit, short-term loans, or working capital financing may help companies bridge temporary gaps. However, borrowing should always be approached carefully. Debt should solve a short-term cash timing issue rather than cover ongoing operational weaknesses. If a business constantly relies on borrowing simply to pay routine expenses, deeper financial problems may exist. Financing should support recovery efforts, not replace sound financial management practices.